All right, welcome back, everybody. This is part 2 of Chapter 9, Accounting for Receivables. In the first part, we went over the direct write-off method, which is not the preferred method and not what we will be using. We will be now diving into the allowance method, which, of course, requires that we estimate what our bad debts are going to be. A couple of benefits of the allowance method, of course, is number one, it records and estimates bad debt expense in the same period when the sales related to that bad debt expense are recorded. So we're matching expenses with the revenues that they're helping create. Remember, extending credit or allowing customers to purchase on account instead of paying us cash does come with some expenses. Naturally, some percentage of them are just not going to pay, but still usually it's worth it for businesses to extend it just to generate a lot more revenue, because only a small percentage are not going to pay usually. And of course, so it does match those bad debt expenses with the revenues that it helps generate, meaning we record both the bad debt expense and the sales in the exact same period. And number two, the other benefit is, of course, it helps us to actually convey what our accounts receivable is, what the asset is, at a real value, what we're going to refer to as the net realizable value. So people may owe us $20,000, but we're not really going to collect $20,000 because we know some percentage of that is not going to be collected. By using the allowance method, in other words, using estimates for bad debt, which we're going to get into, will actually help us report our accounts receivable, our assets, at a proper amount. So again, two advantages. The bad debt expense are estimated, and our accounts receivable, the assets, are estimated at a bit more of a realistic value. So let's go ahead and dive right in. We're going to talk about the methods of estimating as well. One example, let's stick with our TechCom company. Let's say we had credit sales of $300,000 during our first year of operations, to make this example easy. And at the end of the first year, $20,000 of credit sales remained uncollected. In other words, if you were to go look at the total of all the customers that owed us money from the first year's sales, there would be a debit balance in all of the accounts receivable totaling $20,000. And remember, the way we report that on our financial statements is just accounts receivable, $20,000. We wouldn't list every individual customer. One may owe us $1,500, one may owe us $10, one may owe us $300, but that's the total. So a bunch of different accounts receivable, and at the end of the first year, it's a total of $20,000 that's owed to us by many customers. Now, based on the experience of similar businesses, right, because this is our first year of operations, the only way we could estimate the bad debt is to look at similar businesses. Based on similar ones, we estimate that $1,500 of our accounts receivable is going to be uncollectible, meaning we're not going to get that money. So, how would we do that under the allowance method? If we don't know who, we obviously can't write off individual accounts receivable. And frankly, if we knew that they weren't going to pay us, we wouldn't have extended credit to them anyways, right? But the way we do it is we want to record the bad debt expense of $1,500, and the way we credit that is to a new account called Allowance for Doubtful Accounts. And we're going to spend some time with that account because it's a new one for us. Two things to keep in mind here. Number one, nothing has happened for us to create this journal entry, right? It's just the end of the year. We're about to put out our financial statements, and we need to create an allowance and record our bad debt expense because we want our financial statements to be correct. So what kind of a journal entry is this? Of course, it's an adjusting entry, right? Nothing has happened. There's no business transaction. We just do it at the end of the period prior to publishing our financial statements so that they are as accurate as possible. And of course, we're seeing allowance for doubtful accounts. It's a new account that we've never dealt with, and it's specifically a contra asset, meaning it's listed with the asset. Specifically, it's listed right next to the accounts receivable in our general ledger. But rather than having a debit balance as all other assets do, it has, as a contra asset, it has a normal credit balance in it. So after we did this journal entry, this is what the accounts receivable would look like. Again, this is in total, not every individual account listed here, but in total, we'd have a debit balance of $20,000 for all of our accounts receivable, and our allowance for doubtful accounts is going to have $1,500. this is what it would look like on our financial statements. We'd list our accounts receivable and we'd subtract out that balance of allowance for doubtful accounts, showing that our net realizable value, really the value of this asset of receivables, is $18,500. And what I mean by net realizable, when I say we're going to realize $18,500, it means we're going to collect $18,500. Yes, on the books it says $20,000, but we all know we're not going to collect this $1,500. We're going to collect somewhere around $18,500. Remember, accounting figures are not perfect, and especially when we're talking about estimates, they can't be. But they are reliable, and as long as everyone uses the same method, makes it consistent and comparable to other companies. And that's really what accounting is all about. So this is what it would look like and why we would put that allowance for doubtful accounts out there. Now, let's go through some of the same scenarios that we went through before. Let's say we determined that Jay Kent, that same customer who owes us $520 from last year, we realize now in the next year, okay, fast forwarding, let's say we're in January now, is not going to be able to pay that $520 for any of the reasons. He writes us a letter or he calls us and says, sorry guys, I'm out of business, I'm broke, not going to be able to pay you. Nice knowing you. Well, we need to write off Mr. Kent's account receivable, right? And if he owed us $520, there would be a $520 debit balance in his specific account receivable. So we're going to be crediting his account receivable for $520. And rather than taking a bad debt expense, remember we already took the bad debt expense, we just didn't know who was going to be the deadbeat and not pay us. Now we do, so rather than debiting bad debt expense, we debit that new allowance for doubtful accounts account, right? So we already took the bad debt expense. I want to back up and show you that just so you can see what I mean. I'm going to back up here a couple slides. Remember, at the end of the year, right before we put out our financial statements, we took a large bad debt expense of $1,500 because we knew about $1,500 of the total amount owed to us, that $20,000, was going to not be paid. We just didn't know who the deadbeats were going to be and not pay us, right? We didn't know Mr. Kent would be one of them. So rather than going and actually writing off specific accounts receivable, we just put it into this temporary holding account, this allowance for doubtful accounts, so that once we determined who they were, we could take it out of this allowance account. But for now, it's almost just an earmark or a holding place to put for those bad debts that we don't know who is going to not pay us. So we put it into allowance for doubtful accounts, and then in the future, once we finally know who it's not going to be, we will actually debit the allowance for doubtful accounts, not bad debt expense. Because remember, we took the bad debt expense back in the same year as the sales. So we matched the bad debt expense, and now it's just a matter of figuring out who it is that's not going to pay us from that $20,000 total. One key factor in why the allowance method is so great is because writing off a bad debt, once we know that somebody's not going to pay us like Mr. Kent, it doesn't affect the net realizable value of our accounts receivable, right? When we put out our financial statements, in other words, we told the world, yeah, people owe us $20,000, but we think we're not going to collect about $1,500 of that, so we really have an asset with a value of $18,500. That's what we expect to collect. And still, even when we write off Mr. Kent's account, we certainly reduce the total accounts receivable, but we also reduce that allowance. So we still expect to collect $18,500. In other words, we had already accounted for Mr. Kent in the $1,500. So he was part of it, we just didn't know it was him. And as we get a couple more people that are write-offs, they will come out of that allowance for doubtful accounts. Now, of course, this is one of those unique accounts. If, let's say, we have another customer who owes us $1,000 and he all of a sudden says he cannot pay, well, we only have $980 in the allowance for doubtful accounts, right? So that would, of course, be once again a credit to the allowance for doubtful accounts, which would take this, or excuse me, a debit into the allowance for doubtful accounts, which would take the allowance for doubtful accounts into the debit category, right? So this is one of those accounts that while the normal balance is a credit balance, it can occasionally have a debit balance. This is the only account of the first account we've seen that can have both. Remember, it's a contra asset, so it's got a normal credit balance, but it can go into a debit balance if we do not estimate high enough amount of bad debt. So you'll see that, and I want you to be aware of it. Now let's go over the same scenario as though Mr. Kent, after we wrote off his account thinking he wasn't going to pay, all of a sudden he goes ahead and pays his $520, which often customers will do in order to restore their good credit standing or just make good on the debt that they had. So let's assume on March 11th, J. Kent once again pays his full account $520, which we had previously written off. And remember, the way we wrote that off was we credited his accounts receivable for $520 and we debited the allowance for doubtful accounts. And now that he's paid us, we need to reverse that. So we will do the exact opposite. That's the first journal entry, right? We're reestablishing that he owes us $520 by debiting his account receivable of $520, and we're putting that $520 back in the allowance for doubtful accounts, right? We thought that of the $1,500, 520 of it was J. Kent. Turns out we were wrong, so we need to put that money back in the allowance for doubtful accounts until we know which customer is really going to not pay us. And we also have to recognize the fact that Mr. Kent paid us the $520 that he owed us, so we have to credit his accounts receivable to show that he no longer owes us any amount. Kind of interesting that we're doing both here. We're both debiting his account receivable and crediting it for $520. We could, of course, accomplish this by just omitting that, right, and debiting the cash $520 and crediting the allowance for doubtful accounts, but I want you to do this properly. This is the proper method, and I know it seems a little silly to do both these in a journal entry, but please get used to doing it. This is how the book teaches it, and it is proper accounting. So that's the basics of the allowance method. Of course, the allowance method does require that estimate at the end of the period of what bad debts are going to be, and I want to go over a couple examples of how to do that, but we'll take that up in the next video. See you then.